Alright guys, so in today's video, I'm going to take you through ICT liquidity. It's a really important concept. We're going to talk about low resistance, high resistance, but most importantly, how do we actually apply these concepts as traders in the market to phrase the most high probability trades? With that being said, guys, let's get straight into this video. All these swing highs are forms of low resistance liquidity, very close together. All these swing highs, 1, 2, 3, 4, 5, 6, 7, 8. Now, when we're using this, we want to focus on a few things. Number one, we need to see a sweep of sell side or buy side liquidity, and you want to be entering ideally around a macro time frame. Let's hop into the charts and let's look at an example. How do I use liquidity to phrase a trade idea? How do I build a model around ICT liquidity? Liquidity rests above swing highs and swing lows. Let's get that out of the way. Above swing highs, below swing lows, people have their stop losses. As price breaks above a swing high or below a swing low, people may get triggered into trades that are breakout traders. The market likes to target these points. Let's get into the real important stuff, which is going to be talking directly about how to apply liquidity to phrase a trade idea, and more importantly, the types of liquidity that you should be focused on. Let's get straight into it. This framework here that I'm talking about is an A+ framework. This simplifies trading. This simplifies liquidity. This tells you which parts to focus on and which parts to negate, because you don't need to know everything. You just need to have a structured system that you can apply day in and day out. Talk through all the elements here. And if you want to see the live market commentary, check out my two most recent videos. I'll link those now in the video there, and you can see my live market commentary with the Discord going through this exact setup, and in particular, this inversion fair value gap here. Now, looking at the price action, you can see we've got all the elements we need to phrase a high probability trade. We've got a macro from 250 to 310. Every single hour there's a macro. It's at the bottom of the video, right? Macros will hopefully do something important, and when you pair this with pre-analysis, you phrase a high probability trade setup. It's really important to keep in mind. So by this point, guys, if you're taking notes, you need to see these things. You need to see a sweep of sell side. We need to see some kind of smart money reversal, ideally happening around a macro time frame. And the inversion fair value gap is simply just an entry model. That's all it is. It's the best one that I like to use, and we can use that paired with other confluences and the low resistance liquidity to take a high chance or a high probability trade setup. Let's get back in the charts. We sweep that, and do we push through or do we reject? We reject, right? So we sweep liquidity, we reject, we accumulate here, we reject, we invert this fair value gap, we sweep more internal sell side, we push up. And this is what I like to call a change in the state of delivery. Above these down close candles, when we break above and close above, that indicates a change in the state from bearish to bullish. Paired with all this analysis and with the low resistance liquidity, again, you have to have a target. You can have all the entry models you like. You could have the best inversion, breaker, unicorn, CRT mixed with whatever it wants to be mixed with. It doesn't matter what the entry model is if you don't have a clear drawn liquidity. And this is why liquidity is the basis of ICT trading once you understand the PDRAs. And this allows you to actually build a framework and build a narrative. Now, what you guys can probably see is that you can use an inversion if you like myself, or you can even use a bullish gap, an order block, whatever PDRA is there. It's simply just an entry model in this case. The narrative, the low resistance liquidity, the sweep liquidity, these things are way more important alongside the macro as opposed to which PDRA you use to enter. An inversion, bullish gap, order block, volume imbalance, turtle sweep, it honestly does not matter. Focus on getting an idea of where the price is going to go. The rest will come quite easily. So change in the state, we dig back down into what some would refer to as a bullish gap or a busy. And you can see that bullish gap there, price is respecting that. We use that to bounce higher and we take out all that low resistance. This is what you want to be a part of. You want to be a part of a low resistance liquidity run, phrased around a macro, and then using the PDRAs of your choosing. Either an inversion gap here, a turtle soup here, whatever you want to take advantage of, it's completely up to you. Now, just look at another example here from a different session to see how this works. Look at this price action here. It's completely bare, no lipstick on the chart. Let's add on that lipstick. Let's talk about how we can phrase these trades. And this is from Tuesday, the 22nd of October. Same elements, right? We've got a sweep of sell side. We've checked that off the list, number one. Right here, this candle's high, this candle's low. Bang, we've got that inversion fair value gap. Now, here's the thing. Is that enough to enter a trade? Yes. Are we in a macro? Yes. So these things are now lining up. I can draw all this out and we can talk through it, but you can see exactly how this macro, 1250 to 110, presents itself. We invert the fair value gap, the macro pushes up. Where does it push up to? Low resistance buy side liquidity. Buy side, buy side, buy side, buy side, buy side, buy side. These setups will occur every single day, every session, right? There's going to be something similar to this. It's a matter of waiting for this setup to come, and depending on the session that you trade, taking that setup in the particular session that you like to trade. When we sweep liquidity, here's the important part, guys. You have to ask yourself the following question. Do we reject from that point, or do we displace through? If we reject, we're more than likely going to reverse. If we displace through, we're more than likely going to go to the next liquidity point or the next imbalance. We sweep this swing high, do we reject? No. We sweep this swing high, do we reject? No. And this is basic market structure, but also pairing in liquidity sweeps, but more importantly, how to take a trade using liquidity, targeting liquidity, and understanding how the market moves based on only those two things, being liquidity and imbalances, as ICT mentions time and time again. Here are just two examples of how I personally like to use liquidity based on ICT concepts. These are the trades that happen quicker. These are the trades that are going to be in and out. With that being said, guys, I hope you enjoyed this video. If you did, give this video a like. And if you're not subscribed, subscribe to the channel. But until next time, I'll talk to you guys then. Peace.